Welcome back. Now, the oil market is a slippery one. As we await OPEC's market outlook, there's no doubt that geopolitical tensions are fueling price swings, while uncertainty around anticipated U.S. interest rate cuts also weigh. Bjarne Schieldrop, Chief Commodity Analyst at SEB, joins us with his analysis of the oil market. Bjarne, thank you for your time and good afternoon.
Thank you very much for having me.
And let's talk about what we've been seeing with oil. I think at some point we had heard that OPEC plus countries had just tried to cut back on production and output, really trying to keep that price steady. And then there have been all of these global economic shocks. How is the oil price faring at this point?
I mean, actually, the oil price has been doing very well since the start of the year. And it has been a lot of gloom and doom. On the one hand, in terms of fares for the global economy, fare for global oil demand, fare for booming U.S. shale oil production, and lots of bearish views on oil, and also talks that, OPEC will not stay the course, they're going to overproduce and the price will drop and probably going to see 70. And what we have seen is actually that in hindsight, looking back at January, oil inventories, crude and products in the EU16, in Japan and the US together actually fell by 30 million barrels in January. And normally, OECD commercial inventories actually increase by 20 million barrels per day in January. So versus normal seasonal patterns, we've drawn down more than 50, in relative terms, 50 million barrels versus what is normal. That's the difference. So fundamentally, it has been a very solid market for oil. That is very naturally explaining higher oil price, up by $7, $8 since end of December, stronger backwardation, where front month is gaining versus the third month, stronger refinery margins, etc., etc. And, to back this up, looking at global manufacturing PMIs across different countries and globally, yes, they are still sort of in absolute terms on low levels, but in January they all picked up, all heading higher. So, there are a lot of sort of positive backdrops here for oil. And then we have geopolitics, which is sort of a whole chapter for itself, of course.
Yes, I want to touch on the geopolitics in a bit, Bjarne, but I also really want to touch on then what we are seeing. You speak about those PMIs. We've been anticipating, and it could be the most anticipated global recession ever, in history, and we haven't quite seen it materialize. And so when we speak about these PMIs recovering in January and this oil price that is holding up, what does it then tell us about demand issues and what then the global economy is doing?
I mean, I completely agree. I mean, that has been the most surprising thing of all. I mean, where is the recession? Isn't it coming? And we've had an extended downturn, actually, in terms of global manufacturing PMIs, without really turning into a global recession. But I mean, the conditions in China has been worrying in terms of the property market, and of course, the highest interest rates in the U.S. since 2001 has been, of course, the expectations that, we will get the recession. But to the contrary, the US has stayed strong. And I think one of the most interesting pictures I've seen lately is the projections of consumption and production of cement, concrete in the US. And it's just going to boom in 24 and 25. And that is a very vivid example of and reflection of the Biden infrastructure package. The money being spent by the US government on the US economy. And that is probably one good explanation for why the US is doing so well, despite these record high interest rates. But I think, one of the most promising things in the US, in the global economy today, and especially in Europe and the US, is of course the rapidly fading inflation. Because that basically tells you that on the horizon there are interest rate cuts, which again will be very positive for the economy. And then of course the question is, are we going to have a downturn before that happens or after? That's always a question.
We also want to touch on geopolitics. You said it would need a whole chapter. We don't have time for a chapter, but let's definitely touch on this one. This is also really contributed to an uncertain global environment. I would have thought that by now we would see the effect of Middle East tensions, in the oil price, but that seems to not have materialized to date.
I mean, we haven't lost a single barrel of oil in the global market. Yes, there has been rerouting of oil around Africa because it's trouble getting it through the Red Sea and into the Mediterranean through the Suez Canal. And that, of course, is partially bullish for crude oil and oil products. But so far, we haven't lost a single barrel. And I think, what are the views on the Middle East? I think most people, most agencies, including ourselves, don't expect at all to have an all-engulfing war in the Middle East, where we could lose like 10, 20 million barrels per day. But I think everyone, on the contrary to this, everyone expects bombs and rockets and drones going off in the region all through the year. So overall, it's going to be very unstable, very uncomfortable, and very tragic, but not to the point that you have an all-engulfing war. So you're not going to have this, sure, now we lost like 5, 10 million barrels of supply, but it's still going to be very uncomfortable, very tragic, most likely. So it's kind of sort of different flavors of how you look upon on the Middle East. And I think the market is not pricing in a big loss of supply from the Middle East due to geopolitics, but they still expect mostly that this is going to be very, very uncomfortable.
I also want to touch on China. I think we've mentioned it briefly there with what we're seeing in the property sector. But China growing at 5%, what does that do to oil?
I mean, we need to remember that if you look at oil consumption per capita in China, the last data point was that they are still consuming less oil per capita per year than the global average. We tend to think that, China is a super major economy. It is big, right? But it's not advanced like the European and the US economy as of yet. So, consumption is still relatively low versus Europe, for example. I mean, in Europe, we consume something like 10 barrels per capita per year. And in China, it's less than 5, right? So China is far from the level of where Europe consumes oil, where Norway consumes oil per capita per year, and the US more like 20 barrels per capita per year in the US. And in Norway, it's about 13, I think. So, China is still fairly low. And that is why we see oil consumption continue to rise quite robustly in China, irrespectively of the slowdown. And now, yes, it's highly focused and concentrated on petrochemicals, but still, they are still fairly low.
And that's all we have time for today, but always keen to chat. Thank you so much for your time and insights this afternoon. That was SEB's Chief Commodity Analyst, Bjarne Schieldrop.